And it left the following summer gas market in an oversupplied situation. Due to fundamental shifts that are occurring and have been occurring in the gas market, we see the potential for another one of those scenarios to set up. And so we want to talk you through what we're seeing and what this winter's market looks like and the effects that it could have on the following summer and the following winter. So with that, I want to just give you, those who are not familiar with Genscape, just a brief introduction to who we are. We are an energy data and analytics firm. We specialized in the patenting and development of proprietary monitoring technology that helps market participants gain insight into aspects of the market that are otherwise opaque. We then supplement this information with publicly available data and provide analytic interpretation of that data to give market participants a good understanding of supply and demand fundamentals across a variety of commodity groups that you see listed here. So with that, we want to talk about this winter 14-15, and we'll take a pretty fundamental view of it with regards to supply and demand. And starting on the supply side, we'll dive into production and imports. On the production front, we expect that lower 48 gas production will continue to grow and actually accelerate in its pace of growth this winter and beyond. So we'll talk a little bit about that, and we'll flip it over to the demand side of the equation. And what we have been seeing is that demand, like production, has been growing as well. And it's been growing at some pretty impressive rates. That said, the rate of demand growth has not been commensurate, nor do we expect it to be commensurate with the rate of production growth. In addition to that, the nature of the demand growth is such that it remains very weather sensitive in the wintertime. So that, while the demand growth is going to help absorb some of the balance into the market, it will still continue to create pockets of volatility throughout the winter season that we need to pay attention to. Then we want to dive into how the balance looks for the winter ahead. And what we see is that even under extremely cold winter scenarios, even though we have that demand growth will not be sufficient enough to outpace the production growth. And as such, even an extremely cold demand winter will not be enough to absorb the growing market length. And that's going to have implications for prices not just this winter, but into the future seasonal markets ahead. With that in mind, however, that doesn't mean that winter's over and that there are not opportunities out there. We're going to spend a little bit of time talking about some regional variations in both the supply and the demand markets that will create areas of volatility and potentially some trade opportunities for those that are monitoring those. So with that said, let's go ahead and kick it off on the supply side, and we'll start with production. Genscape's production is informed by Genscape unit Spring Rock, based also out of Sugar Land, Texas. And the data that you see here is from Spring Rock's estimate of lower 48 production. And as you can see, production in the past several years has been growing at a very impressive pace. The bulk of the production in recent years has been fed by Appalachia, Marcellus, and Utica. But as we look into the future market, we see that these trends will not only continue but potentially accelerate. In the future market, the East will continue to be the big driver of growth. This winter, we expect that production out of eastern markets will increase by 3.5 BCF per day, winter over winter. But it's important to also note that the Northeast is not just the only driver of production growth. We are seeing production growth in a variety of basins almost coast to coast. A lot of the production does continue to be driven by the pursuit of high-value liquids and crude oil. And as a result, we are getting associated gas volumes in places like the Eagle Ford and the Permian. And the pace of that pursuit of those liquids is such that it is enough to grow gas volumes in those areas. But we're also seeing a restoration of production in the Gulf of Mexico. Some very large fields have been discovered down there, and they're starting to be developed. And of course, up in the northern states in the Bakken, we're seeing new growth or continued growth production occurring there, such that total lower 48 production will be growing. And I should note that one of the risks to this forecast may potentially be to the high side. Estimating Northeast production can be challenging because there is such a large backlog of wells that have been drilled but not completed that are waiting to come online. In addition to that, there is a fairly large inventory of wells that have been tied in but have just been operating at choked back rates. So that if the pipeline takeaway capacity becomes available, it's very easy for producers to fill that capacity very quickly. Also, returning back to the conversation about the Gulf of Mexico, as noted, there have been some very large fields that have been developed down there, the Lucius, the Hadrian, the tubular bells. A lot of those fields are just waiting to come online. Most indications are that they're waiting for a price signal to become available to the market. If we get into a situation this winter where strong demand kicks in and the price signal is there, then these large fields could come on very quickly and continue to make sure that the North American supply market is adequately supplied. So if we take that spring rock forecast and distill it into a winter over winter analysis, what we see is that production in the wintertime has been growing, and in our forecast period, we expect that growth to continue and, as I mentioned, accelerate. In fact, this winter, we are forecasting that total production in the lower 48 will come in at about 5.1 BCF per day greater than last winter. So keep that number in mind, 5.1 BCF per day more production this winter versus last winter. So that's the production side of the equation. The other side of the supply story is, of course, imports from Canada. As we continue to produce more gas in the lower 48, that plus the cost of transport makes the need to import Canadian gas less of an imperative. And you can see that trend has been in progress since 07 or 08. That trend did reverse last year due to the extreme and widespread cold in the lower 48. That is also the increase in imports from Canada last winter was also a product of TransCanada's ability to figure out a way to adjust its tolling structure on its mainline to lure shippers back in that had formerly left that system. That said, looking into this winter, when we forecast based on normal temperatures, while we do expect that TransCanada's tolling adjustments will enable a little bit more gas to flow into the lower 48 market than history would suggest, the return to normal winter should probably wipe out some portion of imports from Canada. In our forecast, we're expecting that total imports from Canada will fall about 0.2 to 0.3 BCF per day winter over winter. So if you recall, our production forecast has us putting 5.1 BCF per day more supply into the market. The lower imports from Canada would take out about, a BCF per day. I misspoke, a BCF per day. So now we're looking at about 4.1 BCF per day total more supply into the market. So the question is, what do we do with this? And this is where the 0.2 BCF per day number comes in. This is with regards to U.S. exports to Mexico. As you can see in the top left chart, the United States has been exporting a growing volume of gas to Mexico. This is largely a product of two factors. Number one, Mexican gas production has been relatively stagnant to declining in many areas. And number two, Mexican demand has been growing. The demand has been driven by the need for new power generation as well as a relatively healthy industrial economy. So because Mexican gas production has been stagnant to declining, the need for Mexico to import more gas from the U.S. has risen. we do not expect any reversal or halt to that trend. In fact, we expect that trend to continue and actually accelerate. This winter, we are expecting that the United States will export 0.2 to 0.3 BCF per day more gas to Mexico than we did last winter. And that will accelerate a little bit as there are some pretty significant pipeline expansion projects that are slated to come online sometime in Q4 of 2014 or early 2015. Most of the two main projects, Sierrita and Agua Dulce, do appear to be on progress. So with that said, we would, if we export an additional 0.25 BCF per day, take that out of our 4.1 BCF per day of extra supply, we're looking at a market that still has about 3.9 BCF per day more supply available than last winter. So that leaves us with the domestic lower 48 market to absorb that. And there are reasons to be relatively bullish on that prospect. The primary reason is because we are seeing very clear indications of structural shifts in the winter demand market. The way we see that is by looking at demand at normal temperatures by month. And what we see is that at normal temperatures on a month-by-month basis, since winter of 2010, 2011, the market has been consuming more and more gas at normal temperatures each month of the winter than the prior year. So for example, in this chart, what we're seeing is that in last winter's December month, demand at normal December temperatures was averaging about 95 BCF per day. In the winter prior, demand at normal December temperatures was 10 BCF per day lower. So at normal temperatures, in almost every single month, we are seeing more gas being consumed than the previous winter. That is a very clear indication of structural shifts occurring in the demand market. Interestingly, if we look at which sectors are driving those shifts, we see that that all of ResCom, industrial, and power is contributing to those shifts. But as you see on the far left, ResCom is the sector that seems to be driving the most radical changes. What we're seeing is a lot of fuel switching in the ResCom sector. In the Northeast, fuel switching entails consumers getting off of fuel oil and connecting into the gas grid. We're seeing a lot of very impressive growth in the Southeast as well with fuel switching. It's a different type of fuel switching. It's more of consumers switching from electric baseboard heating to gas-forced air heating. We also see population growth, new home development, etc. The reason we point this out is because this has very important implications for winter market gas prices, which we'll talk about later. But it speaks to the point that winter gas demand will continue to remain very weather dependent. And this chart really clearly demonstrates just that point. While we are seeing structural shifts in the market that indicate that demand is growing on a per degree basis, when we look back through history, we can see some fluctuations in total non-weather normalized demand. And so that really indicates that demand in the lower 48 is still primarily driven by the effects of weather. So when we recognize that and build that into our forecasts, where does that leave us? Well, if we expect that temperatures this winter, winter 2014, 2015, come in at normal levels, even in spite of the fact that we have structural shifts in the demand market, demand would not be nearly as robust as it was during last winter's extremely cold level. In fact, if temperatures this winter 14-15 are normal, then we should expect to lose about 1.7 BCF per day of demand relative to last winter. So the next question is, well, what happens if we get another winter like last winter? Fortunately, last winter was one of the coldest in the last 60 years, so it provides us a really good barometer for what constitutes an extremely cold winter. Well, if we factor in the structural demand shifts that we are seeing, and we assume that temperatures next winter look exactly like they did last winter, then we would actually grow demand to the tune of about 2.2 BCF per day, winter over winter. So while that growth rate is impressive and would push us well above 90 BCF per day, remember we're still long about 3.9 BCF per day of supply. So the point here is that even if we get an extremely cold winter like we had last winter, and even though we have some new demand that is built into the market, an extremely cold winter will not be enough to prevent us from lengthening the supply of the market. And then getting to the theme of our talk about not getting fooled, let's not forget that it was just 3 winters ago that we saw one of the warmest winters in recent history. And when that happened, that left us with a large oversupply coming out of winter 11-12 that put us with a very large surplus in storage that caused some shifts in the summer demand market. If we were to see temperatures just like we saw in summer 11-12, then we would be talking about the elimination of about 8.1 BCF per day of demand from last winter. So what does this mean for storage and the rest of the winter and even heading into next summer? Well, as many of you know, we are heading into winter with low storage inventories for at least the last 5 winters. At Genscape, we expect that inventories by November 1st will probably reach about 3.55 TCF in storage. That would represent about a 300 BCF deficit to where we entered last winter. If we take our projections that we made for demand, are we okay? People still see the screen?
Hey, Rick, I do not see it anymore.
Okay, sorry. Bear with us for 1 second here. Okay, sorry about that. Need those to go away. There we go. Okay. Sorry about the issues there. So if we take our demand scenario for a normal winter and assume that inventories by November 1st are at 3.55 TCF, then what we would be looking at is an end of winter inventory at about 1.53 TCF in storage. So for relation's sake, if we compare that to where we ended 2011, that was about 1.6 TCF in storage. So as you can see, it's on the lower end relative to history, although not extremely so. And again, that's really due to the fact that we are looking at about 5.1 BCF per day more production in the market. So with a normal winter, we should be exiting winter with relatively normal storage inventories despite going into winter with record low inventories. What happens to end of winter 14-15 inventories if we have an extremely cold winter like we had last year? Well, if we have that, then we are projected to exit winter 14-15 with about 900 BCF of gas in storage. That would not be a record low. Last year would be a record low. It would be about 80 BCF greater than where we exited last winter. Again, a real testament to the fact that even though we're seeing structural demand growth, even extremely cold temperatures would not put us in the same situation that we got ourselves into last winter. And then, of course, if we harken back to temperatures that we saw in winter 11-12, then we would be looking at end of winter inventories at about 2.34 TCF, which is just a shade below where we exited winter 11-12, which put us into a situation where we had record inventories throughout the summer of 12. So basically, under a variety of different demand scenarios, including the extremes, we're looking at heading into summer with normal to slightly above normal inventories with a risk of very high inventories. And that's going to not just weigh on prices this winter, but that is potentially setting up a scenario where prices into summer 15 could be relatively suppressed. So what does that do for the future market? Well, power is one area where some of that length could be absorbed. Next year, and actually starting at the back end of this year, we start to see a pretty impressive number of coal plant retirements scheduled to come offline. Next year, primarily starting in April and extending throughout the summer, we're looking at nearly 22,000 megawatts of coal plants slated to be retired. And what's important is not just the volume of the plants to be retired, but the fact that these plants have been producing at pretty high levels. If you look at what the plants slated for retirement in the year by December 2015, if you look at what they generated in the year 2013, we can see that these plants generated upwards of 6 million megawatt hours per month. And what's important is not just the fact that they were generating a high volume of electricity, but that a lot of these plants are located in zones with serious reliability issues, which basically says that these plants have to be replaced by something and something reliable. And typically that points to gas. In addition to a lot of new gas builds, there are opportunities for increased utilization of existing gas plants. So if we make the assumption that the plants to be retired, the units to be retired by December 2015 were to be replaced by gas, we would be looking at adding 2 BCF per day of new demand over the next 2 winters just to replace those coal units that are being retired. So there are opportunities for gas demand to grow by virtue of replacing coal plants slated for retirement. There's also opportunities within this winter's market. There's going to be a lot of regional variations, and one of the areas that we see continuing to be volatile is the New England Algonquin market. The last 2 winters, the Algonquin Citygate basis price has blown out to levels that we really haven't seen in recent history. People's initial reaction is to say, well, sure, last winter blew out because it was so cold, but the cold temperatures don't necessarily explain what happened in the prior winter when we also saw very extreme price blowouts at Algonquin. What we see is that, yes, last winter was cold, but it wasn't extremely cold relative to the prior winters. And we also see that winter 12-13, when prices were blowing out to great degrees, also was relatively normal in the context of the Algonquin market. So I don't think we can basically use weather alone to explain why prices in that market are blowing out. At Genscape, we think that it's really a function of the structural shifts in fuel switching that have been occurring. As many of you know, demand in the Algonquin market is basically capped due to inbound pipeline constraints and the lack of production in the market. However, even though total demand in the market has a ceiling, what we have seen is the past several winters, demand per degree has been increasing at the Citygate level. So how does Citygate demand per degree increase in a market where total demand cannot? It does it by virtue of pushing out another winter demand sector. In this case, in Algonquin, what we're seeing is that at the extremely cold temperatures, as ResCom demand per degree climbs, power demand per degree is on the decline. Basically, the more gas consumers you're adding into the market, the more the ResCom sector has to directly compete with the power sector for a very limited and finite supply of molecules. And when this has been happening, ResCom has been winning to the point where gas prices have been blowing out and pushing power demand out of the extremely cold portions of the Algonquin winter market. Really where we see this effect kick in is when demand in Algonquin really crests the 1.6 BCF per day mark. When that happens, ResCom demand will bid up power to great degrees to the point where power basically has to withdraw from the market until temperatures revert to somewhat normal, less extreme levels. This is really important to point out because this is a situation that's not just occurring in the Algonquin market, but it's occurring throughout the United States, also in the Southeast, to a lesser extent in some of the Midwest markets. Basically, in a lot of markets, as I've mentioned earlier, we're seeing ResCom growth that can potentially occur at the expense of power demand in the winter market, which could lead to price volatility. And those conditions are likely to exist until you get some relief of inbound capacity constraints, which we don't expect to see this winter. Another function of those constrained markets is what we're calling price bleed. One of the areas that best exemplify price bleed is around Transco Station 190 on the Mid-Atlantic coast. Transco Station 190 used to historically flow gas into the north from southern markets along the Transco line. However, around mid-2013, we discovered that that station had reversed its historic flow direction. We use a methodology to derive those flow values where we can basically see that at some point Station 190 is now flowing northern gas down into the southern markets. Not really much of a surprise due to the fact that Northeast gas is limited in its ability to get into premium Northeast markets, and in light of the fact that demand along the Southeast coast has been growing. So to facilitate that, Station 190 has been flowing north to south. And this has implications on prices. Whereas Transco Zone 5 used to trade at a discount to Transco Zone 6 when Transco was flowing south to north, as soon as those flows reversed to flow north to south, we saw that historic price relationship essentially flip, such that during most parts of the year, Transco Zone 5 is now trading at a premium in order to attract that gas to flow southward. But that said, the Northeast market is still constrained, and it can still call the price shots. And when it does that, it will force some of these nascent infrastructural changes to revert to their old ways. In this case, what we saw is this winter when Transco Zone 6 New York blew out, it basically led the price movement and forced Transco Zone 5 to chase it, and also allowed Transco Station 190 to revert back to its traditional flow direction. So basically, this winter, we still expect Northeast markets to be constrained. As a result, we will continue to see price blowouts, particularly in markets where there's a growth of ResCom competing with power. And at least this winter, and at least until we start breaking through some of those constraints in that market is going to dictate what happens in markets that are seemingly disconnected. And it's important to point out that this is not just limited to markets that are bordering the Northeast, but this effect is happening all the way out to the Pacific coast. What you're looking at here is the volume or the percentage of Rockies gas that flows east versus west. And historically, what determines where the majority of Rockies gas goes is a spread that seems as disparate as coast to coast, the Dominion South versus Malin spread. Historically, when Malin traded at a discount or at a premium to Dominion South, that was sufficient enough to draw the majority of Rockies gas volumes west into the PG&E market. But when prices blew out at Dominion South, that would pull Rockies gas away from western markets and towards the eastern markets. Now, as production grows in the Northeast, it's become more and more difficult for Rockies shippers to get their gas out. Excuse me. Okay. It's become more and more difficult for Rockies shippers to get their gas out into eastern markets. So what we see is that historic price relationships start to break down to the point where Malin almost always trades at a premium to Dominion South. However, it's very important to point out that last winter, due to constraints in the Northeast, due to peak demand periods, that relationship still holds to the point where Dominion South can feature a premium and be sufficient enough to draw Rockies gas volumes away from Western demand markets, forcing the Western demand markets to bid their prices up enough to attract supplies from alternative suppliers, alternatives to the Rockies. So with that said, we don't see the end of volatility in the winter market, even though we are looking at increasing supply length. So to wrap, on the supply side, we are forecasting robust production, continued growth, and growth at a pace that is greater than what we've seen the last couple of winters. We are also rather bullish on the prospects for demand growth, but we do not expect the pace of demand growth to keep pace with the production growth. In addition, the nature of the demand growth is such that it will create portions of volatility within the winter market and make the winter market continue to be susceptible to fluctuations in weather. In addition, even though we are expecting demand growth under normal conditions, which would percolate into extreme conditions, even extremely cold weather this winter would not be enough to absorb the growing length in supply of the market. But that said, there will be areas of opportunity due to volatility within regional markets, as well as the interconnectivity of markets from west to east and north to south. So with that, I'd like to turn it over to Jonathan Gould. He has been monitoring some of the questions that have come in. Jonathan, are there any questions that we got from clients that we should address?
We have a few. We've got one client asking about how much more on the RNC side fuel switching is there to take place? Have we maxed out the customer fuel switching that's leading as part of this RNC growth?
I don't believe we have. Obviously, the question is very regionally dependent, but we keep hearing anecdotally from earnings calls of utilities in the Southeast that new home construction is starting to feature gas forced air heating as opposed to electric baseboard heating. There's population growth occurring in that market. So if we have new customers and new customers looking to put gas in their home, there's opportunities there. In the Northeast, the potential to switch away from fuel oil to gas probably is nearing a maxed out point. I can't put an exact number on that off the top of my head. It's a process that's been occurring for the past couple of years. In addition, facilitating new customer growth in the Northeast is more challenging than in other markets simply because of population density. But in the Midwest, there are opportunities, and in the upper Midwest and the Mid-Con region, there are opportunities for new ResCom growth. But the area that holds the greatest potential is the Southeast.
Okay. We have another question, again, regional specific. It's regarding the recent weak ACO prices relative to the strength that we saw this summer. Any comments there?
Yeah. So ACO was remarkably strong this summer. In fact, ACO basis featured some of the strongest prices we've seen in recent history. That's really a function of two things. One, it was, as with the lower 48 last winter, it was extremely cold in Alberta last winter. Also, there was demand for Alberta gas due to TransCanada's ability to adjust the rates so that it could export. But the second factor also is that when I talk about structural demand shifts, one of the areas where we see the most radical shifts is the Alberta market. There's a lot of population growth there. There's a lot of industrial demand. Natural gas is still heavily used for oil sands projects. The recent weakness, however, has been really interesting. Their production appears to be recovering at a pretty healthy rate from some recent maintenance events. And Genscape's Spring Rock group is forecasting pretty stable production for Alberta into the future. Also, exports out of the Alberta market in recent weeks have been on the decline. That could probably be a function of the storage situation. Alberta is going into winter with record low inventories in storage. We have seen injections around AECO increase. So it may be that folks are capturing seasonal spreads by putting an increased amount of gas into storage as one last push before we get into winter. But injection rates are not nearly sufficient enough to put AECO storage inventories back to normal levels. So there is a risk that some of the U.S. markets that depend on AECO gas could be facing slightly higher prices due to the low storage inventory AECO is facing going into winter.
Okay, I've got a couple more questions. We've got a couple questions on the drop in crude prices relative to gas production, and I'll go ahead and answer that one. We looked at a lower crude curve by around 15 bucks on the 12-month strip, and we see that given that we're already nearing the end of 2014, we see much larger impact in 2016. For 2015 in particular, we see rigs dropping close to 240 rigs, and our gas forecast off around 400, 450 million. For 2016, we see the rig count a little lower, 285 rigs lower, and roughly on average for the year, associated gas production off roughly, dry gas production off 1.5 BCF a day. We'll take we got one more question. We had a question on whether or not we will send the slides out. Yes, we will send the slides out. We also had a question on, where is it at? Some of what's driving the strength out west right now. Rick, you want to answer that one?
Yeah, we have a whole other presentation that focuses just on the Western market. The West is, I'm going to stop short of calling the West the new Northeast, but the West is going to be a very, very interesting market to follow going forward for a variety of reasons. Number one, there is gas demand growth. Some of that growth has been occurring over the past couple years. It accelerated slightly in recent years due to the retirement of the San Onofre nuclear power plant, as well as the fact that the Western markets, particularly California, are still very dependent on hydro. And as many of you know, there's severe drought conditions occurring out there that makes hydro a less available resource in the market. So there are signs of both near-term and long-term gas demand growth. Some of that is being tempered by a very aggressive growth in renewables, but as those markets add renewables, the need to add backstopping gas is growing as well. So we have demand growth out there, and at the same time, the market doesn't really produce any gas of note, so it's wholly dependent on imports. There are small volumes of gas production within the California market, but for the most part, California is dependent on importing gas from Canada, the Rockies, and West Texas. There are no expansions to move more gas into that market. Many of the pipelines that move gas into the market are at very high utilization rates. There's no signs that those are going to change. As I mentioned earlier, Alberta production is growing, so that could be a source of long-term stable supply. But in Spring Rock's forecast, Rockies production is continuing to decline. So you're losing a little bit of supply from that area. Some of that gets offset by the lower exports from the Rockies to the Northeast. But your traditional supply basins in the Rockies and the San Juan are on the decline. And while Spring Rock has West Texas production growing, which could be a source of new gas to the California market, you have to harken back to that slide that I showed about Mexico. So Mexico is effectively upstream of California, and it's basically going to get, it has physical first dibs on that gas coming out of West Texas before it can get to California. So if Mexican consumers can feature a higher enough price, that basically sets up competition within the California gas market. On top of the fact that California, like most of the storage regions across the U.S. and Canada, is entering winter with low inventories. So all of these factors combined, high capacity utilization, growing demand, low storage, some declines in production from its traditional supply basins, all of which are conspiring to basically force PG&E and SoCal Citygate to feature what have been the highest prices in the gas market this summer. That's probably going to be, continue throughout this winter and into the foreseeable future, obviously with exceptions in the day market coming when Northeast demand triggers enough, triggers those inbound constraints. But yeah, the California market is probably going to be featuring some of your greatest premium prices in the North American market into the foreseeable future.
Okay, we'll do one more question. We have a handful of other questions that we'll reach out and answer them directly. The last question pertains to the Mexican exports. We're showing 2.1 BCF a day of Mexican exports. The question is if the infrastructure, if the Mexican infrastructure pipelines are ready for that gas.
The short answer is not yet. So that's a very good question, and there are commensurate expansions occurring in Mexico. They're not necessarily taking place at the exact same time that the expansions from the U.S. are occurring. And as a result, we see, and you can continue to expect to see, lower utilization of the U.S. expansions than one would expect. So while these U.S. expansions are serving consumers under contract, don't expect to see an expansion come online and automatically just fill up. It is going to take a little bit of time on the Mexican side to get not just the pipelines in place, but also the power plants and industrial consumer facilities built and up. So the ramp up is a little slow. So when we forecast our Mexican exports, we're not forecasting based solely on expansion capacity. We are building in an expected utilization that has somewhat of a lag effect due to what is taking place south of the border.
Okay. All right. Thank you very much, Rick.
Great. Yeah, well, thank you, everybody, for participating. These slides will be made available. In addition,